Good afternoon, everybody. My name is David Skok. I am the CEO and editor-in-chief of The Logic. We're going to take a few minutes to let everybody come into the chat, or at least 1 minute, and then we'll get started shortly. So stand by, please. All right. Good afternoon, everybody. Thank you again for joining us. I am David. I am joined today by Kevin Carmichael, a senior fellow at CG and the national business columnist at the Financial Post. The reason I asked Kevin to join us today is because there's been so much news of late about the economic situation in Canada and around the world, particularly around interest rates and inflation, and obviously GameStop was a big thing a couple of weeks ago. And I kind of need a primer. I have massive imposter syndrome, and I thought that I could indulge Kevin for his time to give us a primer on what is happening in the world of finance and economics and how it relates to your life. So with that, Kevin, welcome. Thank you for joining us. And I should just say a little bit more about Kevin. For more than a decade, he has shifted between Ottawa and Washington, D.C., although probably not in the most recent year, writing about economics and politics for Bloomberg News and the Globe and Mail. He was also in Mumbai, and I'd be very curious to talk about India in this period and Modi and what's happening there. And most recently, he's written for Canadian business Maclean's 538 and, of course, the Financial Post. Kevin, welcome. Good afternoon to you.
Yeah, thanks, David. Good to be here.
So we spoke 11 months ago. In fact, on the day we spoke, we did a call with everybody, was the day that the World Health Organization declared COVID-19 a pandemic. When you look back at that time and kind of look to today, what has surprised you? And where do you think, if you were to give us a scorecard, where have we come out?
Let me give the score first. Let me say 7. I'll pull a 7 out of 10 randomly. I mean, I probably should think about that more, but I'll say 7 out of 10, mostly because I tend to keep thinking back to the previous crisis, the financial crisis, and comparing what happened then and the years that followed with what we're seeing happening now. And I think probably the positive, and of course there are lots of negatives, especially when we're all sort of in some sort of form of lockdown. Everything feels negative, but the positive is that this time authorities got sufficient amount of foam on the runway to keep a crash from turning into an absolute disaster. They didn't do that in 2008, 2009. The recession drug on far longer than it had to as a result. This time, I think governments and policymakers, to their credit, hadn't totally forgotten those lessons and did it the right way. They went in hard, they went in fast, didn't ask too many questions. And the other thing I would say is they got the money to more of the right people. And by the right people, I mean households and small businesses. And of course, thinking back to the financial crisis, that's another weak spot of the response there. Just too much of the money went to the banks and the big corporations, which, I mean, maybe you can make a technocratic argument that those were the right people to receive it, but I think recent events and the politics that we've seen since that time sort of showed the downside to ignoring the people who are hurt the most and assuming they might get help through sort of a trickle down approach, and that didn't happen, and so nobody's taking that risk this time. They're getting the money to the people who need it.
So you talk about foam on the runway, and I'm I mean, by foam, we mean liquidity, we mean cash, right? Is it that simple? So what would we, as a thought exercise, if things had not gone well, because one of the hard things about any stimulus or economic response is that you don't know how it could have ended up. You kind of, you're on a curve of here's how it is today, but what would it have been like on the other side? Can you, as a thought exercise for us, explain what it would have looked like or what it could have looked like if that foam on the runway hadn't been there?
Sure. Well, I think you'd see a lot of households far angrier than they are right now. So we see sporadic anti-mask protests. We see sporadic sort of cries from the various lobby groups about how their members are being hurt. And all that's valid. Well, set aside the anti-maskers. I don't know how valid that is, but so people are hurting out there. But these aren't these aren't sort of the cri de coeur that are really emblematic of something seriously wrong with the economy at this point. There are a lot of positives out there. It's interesting to me, the last labor report that came out, I guess it was last week, it was another big drop. The big drop was basically all in retail and restaurants. And hours worked are actually up. So I think that might be the best way to answer your question, David, is that we're still basically, we feel like we're in a crisis. We are. We feel like we're in a recession. We're in something like a recession for sure. But hours worked are up. Incomes are up. Savings rates are up. That overall is a positive. And if we hadn't put that foam on the runway, if we had done things differently, if we'd held back like we did a decade or so ago and worried a little bit too much about deficits, worried a little bit too much about sending money to the wrong people, we wouldn't be seeing that. We'd have there'd be more people hurting than there are right now. I think that's the big difference.
And this is a major shift in economic thinking, right? I mean, there's a whole internal revolution or battle happening or brewing in economics. Can you talk a little bit about what that struggle is, that intellectual struggle around the role of central bankers in stimulating an economy?
Sure. I think, again, it comes back to the lessons of the financial crisis. Maybe start with the central banks first. I mean, one of the issues back then was that there was still this I'm going to call it a preoccupation with inflation. That might not be the best frame. I mean, I think we need to take inflation seriously, of course. That was very much a break for central bankers and lots of people who thought about central banking to being as aggressive as they could. So central banks, even though we remember them as being the heroes of that crisis, and in lots of ways they were, the central banks themselves didn't act as quickly as they could. This time around, for example, I mean, the central banks did about as much in the span of a few weeks that they did over the span of a couple of years back in the financial crisis. And the reason they were able to act so much faster this time around is because they realized that much of what they thought they knew about inflation wasn't quite true. So they realized that they can create hundreds of millions of dollars, I suppose even trillions if you add it all up with what everyone is doing around the world, and not have that big inflationary pulse like they assumed they would be causing back in 2009-10 when they started doing QE, QE1, QE2, etc. So that's sort of the big lesson around central banking. I still don't know that everyone entirely understands why that dynamic isn't playing out like the textbooks told them it would. I think the economy itself has just changed so much for all kinds of different reasons that they've just realized that, like I said, a lot of what they thought they knew isn't quite true. So it's given them the freedom to probe a little bit at the margins. And you're seeing a lot more aggressive probing this time around. And so far, so good, I think. I mean, it's interesting that we talk about this, the inflation, the inflation fears are starting to surface, but it's interesting to me that the central banks aren't the ones that are pushing that this time. They're the ones, in fact, that are pushing that back. So you see the Federal Reserve in the U.S., you see the Bank of Canada saying, yeah, you guys might be worried about inflation, but we're not. And, rates are staying low, well into the next 2 or 3 years.
Yeah, the Fed Reserve said that just last week. 2% is where they think they'll be okay with or comfortable with. So that's a moment for us to step back. What is inflation, and why is it so central in the economic thinking?
Right. So, I mean, inflation is central because about 2 or 3 decades ago, so around like the sort of through the 80s, 90s, inflation had always been a negative force on the economy. When prices take off, it tend to have a pernicious effect. People love to throw around the example of Zimbabwe, wartime Germany, where hyperinflation takes hold, people carting around wheelbarrows full of cash, that sort of thing, just to keep up with everything. I mean, so history tells us, and everybody's pretty sure that inflation ultimately is a bad thing. Central banks sort of, as I said, toward the end of the 80s, early 90s, decided that, well, if we target inflation, lots of good things start to happen, or theoretically lots of good things should start to happen. So to just bring some stability that lets entrepreneurs, businesses sort of plan into the future, and everybody, it just kind of worked. And it does, right? And it did, certainly through most of the 90s, the 2000s. And I think, what we're seeing now is that maybe though we don't need to be quite as rigid about it, right? We don't, so of course, so just, I'll take that step back for you. So central banks decided that they needed to basically, there was a connection between the unemployment rate and inflation. So the debate really that's going on now is that people have realized that for a long time, maybe, and probably central banks didn't recognize that the unemployment rate could fall a lot lower and without causing an inflationary effect. So that's what you're seeing now, is that central banks are far more comfortable with an unemployment rate of, here in Canada, maybe around 5%, maybe 5.5%. In the US, it's lower. But 10 years ago, unemployment rates of that level freaked central banks out, frankly. I mean, they thought that inflation was the next step. So they'd always step, they'd always come up short. They'd always pull the rates back or raise interest rates maybe maybe sooner than they needed to. And that's kind of gets to the debate that's going on now. Central banks are going to roll the dice the other way. They're going to take a risk on the side of growth rather than the side of inflation.
I want to come back to interest rates, but just to help me understand, why would unemployment have led to more inflation?
I'll describe it this way. I mean, so low unemployment means the economy is rolling, things are going well. That suggests that you're basically starting to generating more demand than your economy has the capacity to handle. So, if I'm employed, you're employed, all our friends are employed, we're going to restaurants, we're buying stuff, and eventually all that activity starts to feed on itself, create something of a snowball effect, and then all the restaurants, all the stores can't keep up with all that we want to buy. So what do? Well, they start to raise their prices either for two reasons. One, they can say, "Wow, there's so much demand for our stuff, I might as well be making more of it." But they also can't keep up, so they're trying to keep customers at bay. And so then the inflationary pressure starts to build on itself, and then according to the textbooks, you suddenly have an inflationary episode where if everybody starts raising their prices, then you and I stop spending suddenly because everything's got too expensive, and then our employers suddenly aren't selling anything, so they're firing us, and then next thing you know, we're in a recession.
Thank you for indulging.
Yeah, that's a thumbnail sketch of the way the dynamic works.
So you've mentioned interest rates, and this is where it gets, I see there's a question already, which I expected there would be, about housing prices. And by the way, please send your questions if you have more. I am your conduit for all questions you were afraid to ask. I will do it, and you can be anonymous. I'll take the heat. Okay, so interest rates are a lever that central banks have in order to curb inflation. Why do interest rates matter?
That's an excellent question. They matter ultimately because the interest rate reflects sort of the core price in the economy, and sort of dictates much of what we all do. So I'll start with us again, just normal people. What's our big purchase going to be? A house. What's going to dictate whether we buy that house? Probably the interest rate. So if the central bank wants to stoke the economy, or at the very least the housing market, then it wants lower interest rates. And because the banks key basically everything they do to what the central banks do, is sort of just a chain reaction that starts with the central banks and then moves its way out into the economy from there. So the interest rate is kind of like the pressure release valve. So when central banks want to heat things up, they'll lower interest rates. When they want to take some heat off, they'll raise them. I recall something that I read in Paul Martin's, the former finance minister and prime minister's memoir, when he talked. And of course, he's a long history in business. He always pushed back against those who criticized him for raising taxes or got hung up on tax rates, because he reflected on his own experience as a business person. And he's like, as far as he was concerned, interest rates sort of dictated everything that companies do, and taxes were just sort of a marginal thing. And so you can take the household example or the house market example and extrapolate that to a company that's either trying to get off the ground or expand. I mean, that decision is ultimately going to be dictated by the price of money. So if interest rates are favorable, then if there's an opportunity out there, then that company is probably going to go for it, expand, invest, hire people. If interest rates get too high, then they probably won't.
Yeah. So I'll take, as a small business owner, obviously for us, it's a massive important, because what's the most expensive kind of money? Venture capital money, which is we have. If you can take a loan at a low interest rate, that's much cheaper even than venture debt. So yes, it allows us to then hire more people, spend money to make money.
Yeah.
If the interest rates becomes higher, then that would slow down our growth, and our growth leads to growth in the economy and all the rest of it. Okay. So interest rates are really, really, really low. The lowest they've been in a generation, you can say. What are the trickle effects of that we're seeing? And this is going to lead me into the GameStop piece of it. But if you can kind of walk through that, what low interest rates means what?
Right. So low interest rates mean, well, they mean that there's lots of money, headed to the economy. So so you mentioned GameStop. That's just an opportunity for us to start talking about asset price bubbles. And there are a bunch of them out there right now. And so those economists, people out there who worry about inflation, worry about low interest rates, one of the reasons they do so is that they worry about misallocation of capital. And by misallocation of capital, they mean money rushing into things like the housing market, like the stock market, to a point that it sort of becomes disconnected to reality and sort of asking for a crash at some point. And that is ultimately, I think, probably what we're seeing now, mostly because interest rates never really got a chance to go back up after the last crisis, after the Great Recession. And this gets to what we were talking about earlier, David, about the fact that central banks realized that maybe their alignment between the unemployment rate and inflation was off, and inflation never really came back. So they left interest rates really, really low. Because they did that, we'll think about it in terms of the stock market, for example. So you've got an aging population that's looking for places to save. Well, suddenly you can't get any sort of return by leaving your money in the bank. You can barely get a return by taking out a government bond. So in that sort of environment, the stock market just naturally looks like a better place to invest your money, or the incentives become greater to put your money in the stock market. So that's what you do, and so savers have done that, investors have done that. I mean, the stock market just becomes it's just like they call it the chase for yield. So the stock market becomes a place you go just to earn a little bit of interest, or earn a little bit of something on your savings, on your money.
I think this is I want to interrupt you there, because I think this is a really important point. There's been a lot of talk about retail investors, but in fact, most of the equities market, the stock, is institutional investors. Those institutional investors, pension funds, this is really important, and I don't know how many people actually get this piece. They need greater returns today than they have ever needed as pension funds, because of, you've written about the silver tsunami, the idea that you used to have pension funds that had as many people coming in at entry level who would fund the pension, and then those going out. But those days are long over. And so now you have pension funds, and by the way, correct me if I'm wrong on any of this, but now you have pension funds that need a greater return, 12%, 11%, whereas before they were comfortable with 7 or 8% or 6%. So you now also have not just the retail investors on Reddit, but you have pension funds moving into equities more and more.
Mhm.
Is that right?
Yeah, that's absolutely right. And that's where the real money is in markets. Like that's been one of the big shifts that we've seen over the last couple of decades, is that institutional money, and in particular the pension funds, coming into the stock markets. Basically exactly as you said, David, coming to the realization. I mean, Canada is a great example. We were among the first. The Canada Pension Plan was among the first to recognize that the old way of simply taking our pension contributions and investing that money in government bonds or a safe asset just wasn't going to yield the kind of returns necessary to ensure that there's going to be enough money there when we all start to retire. So they changed the rules and opened the door to going into the markets, and now you see more and more do that. So I think that explains like the elevated stock markets that we've seen over the past few years. That's certainly part of it, that there's just so much institutional money chasing yield that is pushing up the value of these assets. And I think we're at a point now where you see that the pension funds can't even get the return they want out of the stock market. So they've almost become more like private equity investors at this stage than they were sort of stock brokers or stock investors maybe a decade ago.
Yeah, and that's right into the logic wheelhouse why we cover pension funds, where they are more and more frequently in venture, in growth equity, and doing things that normally would have been, kind of on the periphery of their business. Okay, I think we've kind of gone through the cycle there. So what is? I guess there's a question here from Kareem that kind of ties into this. So he's flattering you, and he should. Kevin, you are one of the few Canadian journalists who takes these key policy issues around money and credit and makes them understandable to a large audience. This is true. Right now, the need for that understanding is especially high. Who else should be helping us understand these issues? Are finance departments / the Bank of Canada effective or ineffective as communicators on these issues? And if ineffective, why?
Wow. You'll appreciate, David, my reluctance to declare a favorite, but I'll do it anyway. I've been covering the Bank of Canada for a long time, and I went through a phase where I was on a fairly regular basis describing the Bank of Canada as a black box, or at least a translucent box. Their communication it's not that their communication was bad, as they just didn't refuse to tell us very much. They've changed a lot over the last number of years, and the Bank of Canada, I find a relatively transparent organization, and it's probably, I should even remove relative. It's a fairly transparent organization. I mean, it's a central bank; it can't tell us everything about what it's doing, but it's, to the extent that it can, it does. It communicates clearly. It provides everybody, I think, with a fairly neutral interpretation of what's going on in the economy and financial markets. Finance, unfortunately, does the opposite. And that's not to say anything negative against the people at finance. It's the nature of political communication now. And this government has just extended that. I mean, it's been happening for years. I remember when I started in this business, you could sit down and chat with the deputy minister of finance or any of the ministries, get a better sense of what was going on. That doesn't happen anymore. The messages are just, the political messages are now massaged and managed to such a way that it's just very difficult to have an authentic communication with anything happening in and around Parliament Hill. So it's not to say that they're lying. I just think you have to know the source that you're dealing with, and be prepared that you're not going to get anything out of the government these days that is going to upend their political strategy in any way, unfortunately.
One person who is known to be a good communicator is Evan Siddell, who was considered for the infrastructure bank job and is still with CMHC. And I want to come back to the question that we haven't fully answered yet, which is on housing and the concern over inflation of prices in housing. uh, if you're able to, you wrote recently that, you know, Canada has invested more in real estate. Why is that a bad thing? And the inflationary aspect of home prices, how does that manifest or fold itself back into the conversation that we're having about the broader economy?
Right. Again, I don't. I'll take that. I'll call it a bad thing. I don't. It's just a thing. Ultimately, it's a decision that we collectively are making to plow all our money into real estate. I have come to the conclusion that it's ultimately a bad thing for us as a country, because we're taking what I take to be a finite amount of investment capital, our savings, and putting a disproportionate amount of that into an asset that ultimately is unproductive and does nothing for the strength and capacity of the economy. So again, I'll come back to you and me, David. So say I've got a pile of money that I'm sitting on. I could put it in your company. You could hire some people. You could expand. You could go overseas, continue to grow. Or I can buy a house, or a second house, or a third house. I'm probably going to buy a second or third house because all the incentives line up to allow me to do that far easier than it would be for me to invest in your company. The banks, to start with, because mortgages are ultimately backed up by the government, will give me a loan far quicker to buy a house than they will to invest in the logic. And on down the line, there's all the various government incentives in place, put in place over decades around that idea of making it so regular people can afford to buy a home. Well, all that stuff in this last decade or so like all those things were put in place back in the what we'll call a normal time, when interest rates were higher than they are now. It was actually somewhat difficult to get in a home. So the government's tried to help that situation by putting in place various subsidies to help people do that. Well, all those subsidies are now in place, but the things they were put in place to offset higher interest rates are now rock bottom. So now everything is there's just a green light to plow your money at an individual level, to plow your money into real estate. You multiply those individual decisions across the economy, and suddenly we're putting all of our savings into real estate. Not all, obviously, but a significant proportion of our savings into real estate. And we're underinvesting in our businesses. And that's relevant in the data, that's obvious in the data. And it's obvious in our ability to sort of maintain a productive economy. I mean, the Bank of Canada's estimate for how much for economic growth that's non-inflationary, which is sort of, it describes as like the economy's capacity, its ability to grow without stoking inflation. That estimate is around 1.4%. 1.4%. That's a miserable rate of growth. But that's basically a statement on how fast the Bank of Canada and how fast as an economy we can grow without overheating. And that's mostly the result of lack of investment over the past couple of decades.
This time is going by very quickly, which is a great thing. You've really helped clarify a lot of these things. I want to throw three more words at you, and hopefully you can kind of explain how they are fitting into all of this as well. One is digital currency, and where that fits into all of this, and how the Bank of Canada is dealing with that. The second one is currency. US dollar, Canadian dollar, and how the liquidity, to answer Jerry's question here about all of this liquidity in the market, what the impact of that could be on the dollar. And the third one, and maybe it's tied to housing, is immigration and productivity, and the role of immigration and the need for immigration in this country at this moment. So 3 words. Hopefully you can kind of
3 words, another half hour on the phone.
Yeah.
Immigration is really important, and it relates to what we were just talking about, and sort of the Canada's poor productivity rate. If we were more productive, if we were a stronger economy, able to generate more wealth with the people that we have in place, immigration wouldn't be so vital. I mean, in any situation, I'm pro-immigration. I mean, the more ideas you crowd into your economy, the stronger, the more dynamic economy you're going to have. But so that's one reason why immigration is important in any time. But it's particularly important for Canada because we need to crowd people into the economy because we can't generate enough with what we have. We need to add resources we need more economic actors, basically, if I can put it that way. The U.S. dollar is a interestingly a huge issue for the Canadian economy at the moment. It's remarkable to me that the Bank of Canada has started to talk about it quite unreservedly, which is a new one for me. As I said, I've been watching these guys for a long time, for a better part of 20 years now, and they really don't like to wade into the currency markets unless they really have to. So it's notable to me that the current governor, Tiff Macklem, has decided that he has to, and that's simply because a stronger Canadian dollar has become an important headwind to the economy's ability to get out of the crisis. And again, that ties into the productivity factor, because the economy is not quite strong enough on its own. The currency becomes that we're that sensitive to, or we become that sensitive to exchange rates that's basically a low dollar has become a competitive advantage. And you probably don't want to leave yourself vulnerable to currency markets, but we are. I kind of think that's more important as we shift into a digital economy, because the exchange rate, I've talked to probably a number of your readers. I don't know that there's been enough empirical or enough evidence out there yet to prove this empirically, but I have the sense that because so many digital companies are in a situation where they're just employing people here in Canada and selling their services or their software around the world, that the exchange rate is really like a windfall for these sorts of companies. So that makes it even more important to help these companies sort of take off. Whereas manufacturers of goods have sort of learned how to deal with the global economy. They have ways to hedge against movements in the exchange rate, either by pure hedges, buying options or whatever, or because their inputs are coming from somewhere else, that these things tend to wash out at the end of the day. But a digital company that's not really bringing in inputs from the US or some other part of the world, the exchange rate becomes that much more of an important factor for that kind of company. So yeah, the exchange rates become a big issue for the Canadian economy, I think. And digital currency, yeah, I mean, I think going into this thing, the central banks, I think, thought they had a lot of time to sort this out. And I think events have shown that maybe they don't have as much time as they thought they did. At the start of last year, the Bank of Canada was of the mind that there was no rush because, because two things that occurred to them, or two things were happening, right? I mean, the Facebook push was faltering, so that didn't look like as much of a threat. Libra thing was suddenly going nowhere, and then lots of people were still using cash. So 12 months ago it wasn't an issue, but now a lot fewer people are using cash. So I think digital currency has to be on the horizon, if not imminent. I mean, they're already doing it in a bunch of countries, including China. So it's almost, it seems to me, and it's inevitable at this stage.
Okay, we've gone over our limit. I'm going to ask you one more question. We didn't even have time to get into stagflation or China or fiscal anchors, but maybe I'll try squeeze this fiscal anchor stuff into the last question. We're now seemingly nearing the end of the second wave, or going, coming to the conclusion of the second wave. What have we learned from the second wave that we should be thinking about if there's a third wave? And what will you be looking for over the coming months both at the Department of Finance level and the Bank of Canada level that will give you something to have a signpost on how we're doing. In other words, what can our readers, what should our readers be looking for as signals of the improving health of the economy or the ailing?
Sure. Well, I mean, the most important thing, at least for the short term, is indicators or information around vaccines, the extent, the rigidity or the tightness of the various lockdowns. Like I said earlier in the conversation, I mean, at this stage, the anchor for growth is just what's going on in the hospitality sector, basically. So as soon as those things, as soon as those industries have a chance to breathe again, you know, the economy should, if not take off, at least get some momentum back. Because there's still enough money circulating that as soon as these restaurants, as soon as these stores start to open, then, you know, people should go back. What I'm looking at around finance is the quality of the spending from this point forward, as opposed to the quantity. So in the earliest moments of the crisis, and I'd say, you know what, so sort of through the acute phase, quantity was important. You just need to get money to people to help them get through this. I think we've learned enough to probably, you know, even if there is a third wave, we're learning all the time how to keep the more and more of the economy open, so we just don't have to lock down everything to keep people safe. We can sort of do this in a smarter, more staggered way. And companies are learning too, right? So each wave, you know, companies are always adapting and figuring out ways to get their goods and services to people. So that aspect should become less and less severe. But I think what we need to do is create some sort of a tailwind to really push us out of this. And we need to be thinking about getting beyond just, you know, getting back to where we were 12 months ago. We need to be pushing forward into what is really a new economy, right? We need to embrace, at least if not carbon-free, carbon-light economy. We need to accelerate into the digital economy. And you know, as your listeners will have gathered from our conversation, is the data suggests that we're behind. So if the politics are such that you know, the current government thinks that it can spend up to $100 billion and get away with it, and the interest rates are such that we can finance that without it becoming too great a burden, then we should probably do it. But we need to be smart about it. We just can't sort of throw it out there willy-nilly like we were, you know, 6 or 9 months ago, when that was the right thing to do. The right thing to do now is to take that money and deploy it in a smart way to ensure that, you know, the economy ends up more productive at the end of this than it was, say, a year or two ago.
A productive economy, part of that is understanding the economy. And I think that oftentimes we use acronyms and have a assumption of base level knowledge in all of this stuff and how it interplays with each other that I think does a disservice to the importance of what it means to the economy. And there is nobody, to Kareem's point, who does that better than you do. I'm so grateful that you have indulged me by walking me through a lot of these things. And I hope it was as informative for our listeners as it was for me. Kevin, thank you as always for your time. And I hope we get to do it again soon.
Of course, anytime, David.
Thank you. And thanks everyone for listening.